Hello, everyone, and welcome again to our monthly REIA Now update call. We're going to give it a second and let everyone get in so they can join us today on what at least here is a hot and muggy but beautiful afternoon. And I generally say, but even more today, I know you have choices of other places that you could be. So thank you very much for choosing to be with us. People are still coming in, so just a couple more moments. I am very excited about today, so I want to go ahead and get started fairly quickly. Charles does have some legislative items that he needs to cover as well, so we're going to jump right on in. Again, welcome to the REIA Now update. We're so glad you were able to make it and happy that you are here. Thank you for being part of this group and hopefully part of your local group. Today, we have Charles Tassell, our COO here at National REIA and in charge of all things legislative to keep you in the know. And I'm super excited to welcome Rick Sharga. He's president and CEO of CJ Patrick Company, and he's going to give us a mid-year update. So all kinds of things we've kind of seen coming down the pike, and I can't wait to hear what he has to say about where this is all heading. Now, that being said, today we're going to talk about some things that may have you change a little bit of your strategy or have some questions and some challenges with your finances or legal things. We are not attorneys and we're not financial planners. So if you have any questions or concerns relating to that, please seek out someone in your own group. And it'd be great if you could do that by looking for them in your own REIA's directory. We are a nonprofit trade association. We've got over about 120 local groups, 40,000 members plus, going about 250 associations nationwide. And we are here to promote, protect, and educate. We've been around for nearing 40 years now. We are sponsored by, especially in this broadcast, Home Depot Pro. They have all kinds of special programs for investors, things like discounts on paint up to 20% off, and the discounts at the register. We have rebates and we have other exclusive programs with them. You can find those, again, at your local REIA. If you're looking for that local REIA to join and all the goodies that they have for you, you can come to our website at nationalreia.org. You can see what you would see on the screen when you get there. When you click here on our individual investor, you can find out more about us under the Y Join. But if you're looking for your local REIA, you can click right here and it will bring up a map of the US where you can find the group that is closest to you for all things that you need. You can click through, or you, like I said, you can come back and find us and what we can do for you at National and the goodies that we have in under the Y Join page. Now I'm going to take no more time and hand it back to Charles so you can give us an update on legislative, sir.
Thank you very much, Rebecca. So a couple of updates for folks real quick. There's, if you remember at mid-year, and you've shared this out a little bit, one of the things I talked about was the blueprint that came out from the White House on the renters rights, right? So one of the pieces of that was this fallout from, okay, we're going to have transparency. What does it mean to understand the real cost of a rental? And we've talked about it in terms of Department of Energy is looking at benchmarking and what utility costs are. Well, one of the things that came out this week is also related to that, and that is what's called junk fees. Put a link out there to our real estate investing today. Brad has it up, and this is, again, one of those things. Again, one man's junk is another man's treasure, I think is another way of saying it. But there are some legitimate concerns that they bring up. You know, if you don't have your fees laid out in your lease, you don't have some clarity and some transparency. That's really what they want to go after. And what I've want to encourage you to look at is right now, especially as we are in kind of a summer lull, there are a lot of local races across the country that are gearing up, whether it's township trustees, mayors, council members and such that are running for local office. Reach out to them, talk to them, make sure they understand you're a stakeholder in the community, and make sure they understand what industry standards are and what's expected in your community. Again, 50 different standards because we have landlord tenant law, as it's still called in most places, housing provider law is different in all 50 states and should continue to be distinguished in those different states because of something called the 10th Amendment. But without going down that track in Pacific Legal Foundation and the work that they've done, but I do want to mention, take a look at this on junk fees because your local groups are going to be utilizing this. I met with a local council member recently, and one of the things he says, look, everybody who rents property right now, if you're renting housing, you're the bad guy. That's campaign wise, that's how it's going to be. You're the bad guy, and we're going to be, you got to deal with the rhetoric for the next 2-3 months until we get reelected. Then we can sit down and really talk to you. It's like, well, at least it's refreshingly honest, I mean, that's the realities of where we're at. So keep that in mind. Please read the article, take a look at it, see what you think, and just be ready for controversy, comments, thoughts along those lines from your locals. Because again, as we talked about, the blueprint on renter rights wasn't a bill in the sense of a classic, here's a legislative body giving set of rights or set of rules and laws. It was the executive branch saying, we don't have the authority to do this. So we're going to tell you, here's our principles. We want some of our different departments to work on things, but we want all the locals to go start pushing this. And we're going to act like we have the authority until somebody pushes back on us. One of those is actually a request for information that was put out by the FHFA. And there is a deadline coming up on that. And there's an article that we've got, and we're partnering with National Apartment Association, National Multi-Housing Council on. And so a number of you are going to receive an email from me asking you to send a specific letter in on this. This is not a, excuse me, this is not a broad voter voice effort. Voter voice does not engage in, they engage in rulemaking, not in requests for information. So this goes through its own little portal. And so we have to do this specifically. And there's a process set up that we worked with the NAA and MHC. So we are going to share that out. So, but keep an eye out for that. And this is one of those fun things that we've got to make some comments because further down the road, there will be legislation most likely coming on this and or rules coming on this, which is most likely what will happen because legislatively with this House and Senate, nothing is moving forward unless it's absolutely essential. So we've got the log jam, but in the meantime, let's deal with the rules. Here's some of the fallout from it. So please read it, be informed, and then we will continue working on that and advocating on your behalf. So with that, I'm not going to take too much longer here. I do want to jump over and transition and welcome Rick today. I've gotten to know Rick over the years. We run into each other and we had a great dinner and a couple other things at a recent event I am in. And Rick is now the founder and CEO of the CJ Patrick Company, doing consulting. And I know why he's doing consulting because he's got a wealth of knowledge coming from his background, most recently with Adam Data, and can I say this politely that I'm a data geek, so that some of us get into that side of it and we really want to enjoy it. So I say that with the highest of appreciation for that side of things. But he's got a variety of things, and from a founding member of 5-star National Mortgage Servicing Association to on the board of directors of the Asian Real Estate Association, National Association of Default Professionals. So when we say that he's plugged in, he is very much plugged in. Twice named on the Inman News 100. He gets around on the media as well. So we really appreciate him with over 20 years experience, bringing that wealth of knowledge to us here at National REIA. And Rick, welcome today, and thank you for coming.
Thank you very much, Charles. I apologize to the group for a little bit of an echo in the audio today. I'm actually at a live event in between doing two panels. So you're getting to what I'm really well prepared. Let's put it that way. That's a good thing. I'm going to attempt to share my screen here. Bear with me one second. And I love Zoom some days, and some days I don't. Okay, is everybody seeing the screen?
Perfect. Looks good.
Okay, we're going to go through about a 2.5-hour session today in the next 30 minutes. So I'm going to go pretty quickly. I have shared the presentation with Charles and team. And if anybody would like a copy of it, feel free to distribute it as widely as you'd like. So we're going to cover the U.S. economy today, what's going on, because that has an awful lot of bearing on what all of us do, certainly in this market. We're going to talk a little bit about existing and new home sales. We're going to talk about what I'm seeing in investor activity out in the market. I know a lot of you are interested in distressed properties. I'm going to talk about what we're seeing in the foreclosure market, and then offer some closing thoughts. And if we have time, I'd be happy to field some questions. So without further ado, we're going to jump right into the economy. Before anybody asks, no, we are not in a recession. Far from it. In fact, the first quarter, when some people thought we'd be going into a recession, the gross domestic product actually grew by about 1.3%. You can see on the left-hand side of this chart the roller coaster ride we went through during the COVID pandemic, when the government shut everything down and then reopened everything. We had the largest single quarterly drop in GDP in history, followed by the largest single quarterly gain. And we've had fairly strong economic trends ever since then. We had 2 negative quarters last year. At the beginning of the year, some people thought we were in a recession because that's the technical definition economists use, is consecutive negative quarters in the GDP. But everything else about the economy was just going gangbusters. So the little group, the NBREC, which is this cabal of economists that gets together, and I believe they have some sort of tantric mantra that they do. They chant, they toss dice, they burn sage, and that's how they decide if we really were or we're not in a recession. It's a little bit like when the Catholic Church elects a pope. You don't know really what the cardinals are doing, but when you see white smoke come out of the chimney, you know you have a new pope. That's kind of how we determine if we're in a recession or not. And what I will tell you is that for reasons I'll cover in a few minutes, I do think we're still more likely than not to see a recession, but we're certainly not in one now. And one of the reasons for that is the health of the U.S. consumer. About 70% of the GDP is based on consumer spending. There are other elements like housing. Real estate contributes to this, like business spending. And there's a number of other aspects that are involved. But the consumer is carrying the day right now, and we'll get into why that might not be all that positive as we move forward. So one of the factors in the U.S. economy, and this ties into everything we're going to talk about, is that the jobs market is still really, really very strong. Unemployment is still near historically low levels. Keep in mind that economists will tell you that a 5% unemployment rate really represents full employment. And we've been spoiled by unemployment rates below 4% for several years now. We had that massive jump when the shutdown occurred due to COVID. We lost 22 million jobs virtually overnight. Unemployment nationally went up to about 15%. Compare that to the Great Recession, and unemployment there peaked at about 11%. But there were two things that were very different about this unemployment wave. One was its rapid recovery. When we look at the Great Recession, it took us a full decade to recover all the jobs that were lost. That's the end of the the end of the Bush administration, the entirety of the Obama administration, and the beginning of the Trump administration. So it took us 10 years to get all those jobs back. In this case, it's been less than 2 years, and we've not only gained all the jobs we've lost, we've added some. And in fact, there are more jobs still available across the country, about 9.6 million job openings, and there are people looking for work, about 6 million people. Very unusual set of circumstances. And these aren't all jobs at McDonald's. A lot of these are really good jobs. They're manufacturing, they're government jobs, they're in the financial services industry. So it's been really a really incredible recovery. The other difference this time is that if you have a normal recession, you have job losses across the board, everywhere. Blue collar, white collar, government, private sector, you name it, we have job losses. In this particular case, almost all the jobs were lost in the service sector. So we're talking restaurants and retail, travel, tourism, hospitality, entertainment. So those were the jobs that were predominantly lost. Those workers tend to be younger, they tend to have less formal education, they tend to be making less money. Because of that, they very often tend to be renters rather than homeowners. So one of the reasons the housing market was really sort of insulated from damage during COVID was because a lot of the people who lost their jobs not only weren't homeowners, but weren't even close to being homeowners. So it's been a really unusual set of circumstances that the COVID recession hit us with. I mentioned there are more jobs available than there are people looking for work. What that has led to is wage growth. It's been very, very consistent. The two things I'm looking at here are average hourly wages and wage and salary growth. So the dotted line is the wage and salary growth. We're running at about 4 to 5% year over year in terms of wage growth. That's really important for the housing market right now because of affordability issues. And this is the first time I've been able to say in about 10 years that wage growth is moving faster than home price appreciation. So if you look at year over year home prices, they're actually down a little less than 1%, but wages are going up year over year by 4 to 5%. So that's a really important metric to be following. On the other hand, the Federal Reserve is a little bit concerned about wage inflation because apparently they don't like it when people make money. And so that's something that's a factor in their decision about how aggressive they need to continue to be raising the Fed funds rate. But the bottom line here, one of the reasons consumer households are fairly healthy financially right now is because wages are moving in the right direction. Because of that, we've seen consumer spending continue to grow. That's the dotted line you're looking at here. But this is a very unusual chart. You'll have to take my word for it because Charles and I are probably the biggest data geeks on the call today. But usually consumer confidence, which is the blue bars here, and consumer spending go hand in hand. The more confident the consumer, the more likely they are to spend money. That's particularly true on big ticket items like cars and houses. And what happened is that was true as we got into the pandemic and started to recover. But then afterwards, consumer spending kept going up while consumer confidence has clearly been a little shakier. And initially, the reason for consumer confidence being weak was COVID and every next wave of COVID that we experienced. But now it's more things like inflation, Russia invading Ukraine, energy costs going up, the government being dysfunctional or at least disruptive. So it's those sorts of things. And my concern looking at this is one of my economic red flags. My concern with this is if consumer confidence doesn't improve, at some point we might worry ourselves to a point where consumer spending starts to slow down a bit. And some of this consumer spending was really caused by the stimulus that the government put into the economy. Frankly, we overstimulated the economy. The first stimulus package was probably necessary. The second one was probably overkill. The chief economist at the Mortgage Bankers Association once referred to it as trying to stuff $15 trillion into a $3 trillion hole, which I thought was a pretty good analogy. So a lot of this is spending because people had more money and they had the opportunity to spend. There was also pent-up demand because of supply chain disruptions. I know in my household, as an example, took us about a year to order a replacement stovetop. So it just is a little bit of pent-up spending. So this is red flag number one. This is related to that red flag, a concern that a lot of the spending is now being done on credit cards. So we've had 2 consecutive quarters with the highest credit card use of all time, over $1 trillion a quarter in credit card use. This is generally speaking not a necessarily healthy indicator. And a concern here is that in a high inflation environment, we have households who are kind of at the median level of income or below, who may be tapping into their credit cards to make ends meet. We've seen how that movie ends before. It doesn't typically have a particularly happy ending. So this is a metric that we're watching, and we're starting to see credit card delinquencies go up a bit. What's reassuring so far is that it's generally in the 30-day delinquencies, but we're not seeing the delinquencies get more serious. But again, it's something that bears watching in this economy. And keep in mind that if you're trying to flip a house or you're looking to rent a property, if you have a consumer who goes south on their credit cards, that's going to have an impact on their availability to get a loan, or on maybe their FICO score that's going to make them more of a rental risk. So this is kind of an important metric to keep your eye on. The other red flag that's related to this is we've gone from record high levels of savings rates down to almost record low levels of savings rates. And again, this is sort of tied into the government's stimulus program. They were sending out checks to just about everybody, enhanced unemployment benefits, and all this during a time when you really couldn't find a lot to buy. And so we saw a lot of people either pay down their debts or put money in the bank, which is what stimulated these very high savings rates. But now we're also afraid that we're seeing people tap into their savings to make ends meet. And again, that potentially is a red flag. These last two things are I believe, weighing on the Fed and causing them to be as aggressive as they can to get inflation back under control. Because again, if you're looking at that household with marginal income, inflation at 8, 9, 10% is a real challenge, and could be a catastrophe financially for those households. So they're trying to get back down to that 2% target as quickly as possible. And this is just to kind of show you where they're coming from. For a number of years, they were having a hard time getting inflation up to 2%. And we went through that whole period of a zero interest rate market with the Fed funds. They've admitted now that they underestimated how bad inflation was going to get. They admitted that they underestimated how sticky it would be and how long it would be around. And they underestimated how difficult it was going to be to get it under control. So very unusual for a Federal Reserve group to be as transparent as they've been talking about all of that. But what they've been doing, and I'll show you graphically what they've been doing in a second, but what they've been doing is having an effect. Those blue bars are the U.S. inflation rate as it's reported. The last report came out, I don't think I have it on this chart, but the last report came out at 3% year-over-year inflation, which sounds to me very, very close to their desired target of 2%. The other thing to look at is the consumer price index, and that includes some things that the overall inflation rate doesn't include. So it'll include things like food and energy costs. So we're having a little bit more trouble getting that one down under control than overall inflation, which means that the price of some goods and services are really coming down faster than others. I use Costco as my personal example because I like to buy my salmon at Costco. And a year ago, that salmon was selling for $9.99 a pound. And today it's selling for $12.99 a pound. So pretty significant inflation on that. And how they determine the inflation rate is a fairly complex algorithm, but it does look at things like that kind of food price increase, what's going on in housing and rental costs, and then it weighs those things. So just because food might be up 10% overall doesn't mean inflation is up 10%. It's one factor. One of the lagging indicators that the Federal Reserve does not update on a timely basis is housing costs. And they typically look at rental rates and what they call rental equivalency, which is for those of us who have a mortgage instead of paying rent. And that data typically lags behind for about a year. I don't know why they don't update it, but they use year-old data. And a year ago, rental rates were going up at an extraordinary pace. What we've started to see in subsequent months is as the data has gotten closer and closer to being timely, we're seeing those rental indices come down to closer to what we're seeing today, which is very nominal rental rates. As that happens, you'll see an impact on inflation, and the inflation numbers will continue to come down. So I'm very, very hopeful that sooner than later, the Fed's going to hit its target. And this is why I'm hopeful. If you look at the shaded areas here, that's when the Fed has raised the Fed funds rate in an effort to combat inflation. And what they normally do is what you saw back in 2016. They'll raise it a little bit, wait, see how it works, raise it a little bit more, wait, see how it works. and they go step by step until inflation comes down. In this case, inflation was kind of at a runaway rate, 9%, before they did anything. And so to combat that, they have raised rates more quickly and higher than at any time in history. They got higher than this back in the 80s, but they didn't raise the rates quite this quickly. And what that's done is had a shock to the overall financial markets. It is solely the reason why mortgage rates are as high as they are today. And until they decide to start coming back down, it's going to be hard to see those mortgage rates retreat even a little bit. So this is what's happened. This is why the financial markets have kind of gone sideways. And this is also why I'm more confident than not that we're going to see a recession. There's two historical things I'll show you, then we'll get into the housing market that lead me to believe we'll see a recession. This was a chart put together by the chief economist at Fannie Mae. I hope he doesn't mind that I've been borrowing it for a while now. But if you go back as far as World War II, the Federal Reserve has raised the Fed funds rate 11 times in an effort to get inflation under control. 8 of those times, the red arrows, they've overcorrected and steered us into a recession. The 3 green arrows are where they actually executed a soft landing. And in those three cases, what they all have in common is that the Fed acted before inflation got too high. So they acted proactively to keep inflation from getting out of control, and were therefore able to steer us into that soft landing. In this case, they've already admitted they missed that window. They've had to be very, very aggressive, more aggressive than usual, with the Fed funds rate increases. And so again, I'm inclined to believe that this will be the 9th time out of 12 that they've had to overcorrect and steer the economy into a recession. The other historical data point is something called a yield curve inversion. I don't want to get too inside baseball on you, but basically, typically the way the bonds market works is if you're invested in a 10-year bond, your yield will be higher than if you're invested in a 2-year bond, because it's a longer investment. You want to get a better return, more risk involved, so forth and so on. Every now and then the bond market gets a sniff of blood in the water, realizes that something is not good, and is likely to have a recessionary effect. And at that point, and typically what's happening then is the Fed's funds rate is going up. And so short-term yields get higher than long-term yields. So the 2-year bond is paying more than the 10-year bond. That's called a yield curve inversion because the rates have inverted. They've shifted places. We've been in one of the longer and deeper yield curve inversions now for many months, where the yields are a full point apart at this point between the 10-year and the 2-year. And the last 7 times that's happened, we've seen a recession follow. And I just don't see any reason to believe that this 8th time won't follow suit. Now, the good news, if there is good news that has to do with the recession, is that every other element of the economy is performing very, very well. Productivity is high, unemployment is low, job growth is strong, trade isn't even that bad right now. Right? So a lot of good things going for us in the economy. And so if we do have a recession, it's likely to be fairly short and fairly mild. But again, just because of these historical data points, I don't see a way out of some sort of recession. Economists keep pushing it back. They've been expecting it as early as the 2nd quarter of this year. Right now, most of them are pointing at the 4th quarter this year, the beginning of next year. If it makes you feel any better, very, very unlikely that we will see a recession as we get into the teeth of the presidential election. Somehow the incumbents always manage to get us out of a recession when they're running for re-election. I don't know how that happens. It's a remarkable coincidence. But that's another reason to suspect if we do have a recession, it probably won't be one that lasts very long. And what will happen, however, if we have a recession, is unemployment will go up a bit, might go up. The most rational economists that I follow are saying maybe it goes up to 4.5 or 5%, which is still very, very strong employment. But it will lead to a little bit more of an issue, particularly in the housing market when it comes to foreclosures and delinquencies.
So Rick, can I interrupt you real quick here?
Sorry.
But before you go into the housing market side, there's a lot of theory and rumor on a question of possibly 2 more Fed increases even yet this year, possibly 25 points. There's discussion on those lines. Not asking you to be a prophet, And everybody's kind of concerned about that because that goes into our whole next phase of the housing side. Do you think it's likely? And especially they've taken an aggressive approach, but I agree with you that all the other pieces kind of go, this is all set for a soft landing, just let it ride kind of thing. What are your thoughts on that?
I will almost guarantee you that there will be a 25 basis points increase in July. They're all saying that. So all the signs point to that. The good news is the market has already baked that one in. So that one will surprise absolutely no one. What I am hopeful for is after that, they take a deep breath, take a step back. And I've heard some of the governors from the Fed already say that out loud, that we should probably do that. Could we have another 25 basis points hike later this year? Maybe. I'm hoping they give it a month, see what the inflation numbers look like, and then conclude that what they've done is having enough of an impact that they don't have to do anymore. But my personal worst case scenario is we have 2 more 25 basis point hikes, and then they take a pause and stop. And what I will tell you and the folks here is that historically, every time they've announced that they're stopping with the Fed fund rate increases, we've seen mortgage rates start to come down. So I am of the belief, and this is a few weeks ago from Freddie Mac. Today's rates are probably closer to 7, but for the last couple of months, we've been seeing mortgage rates on the 30-year go somewhere between 6.5% and 7%, pretty tight band. I expect that we'll probably see that continue through August. If the Fed does announce it's going to hold raises, I think we'll then see mortgage rates steadily come down for the rest of the year, slowly but steadily. And I would not be surprised, unless we have any unpleasant surprises in inflation, if we didn't see a 30-year fixed rate loan by the end of the year dip below 6%. So I'm very hopeful we see that. I believe we'll definitely see that next year. And if we do enter a recession, the Fed might have to think about reducing Fed funds rates, which would also give some cover for the mortgage industry to start reducing things. The spread, the 30-year treasury, the 30-year mortgage rate is loosely based on the yields on the 10-year treasury that we were just talking about. So they're running at about, the yield right now is about 3.9%. In a normal market, that would mean that we shouldn't have a mortgage rate higher than 5.9%. And in some cases, it would be as low as 5.4%. Right now, we're running a full point higher than normal because the market is pricing in risk and volatility because they're not sure what the Fed's going to do. But once the Fed lets the market settle down, we could see these rates come down by a full point in a relatively short period of time. So everybody keep your fingers crossed the Fed doesn't keep going crazy. Because of what's been going on with mortgages, we've seen a drop off in demand. And the 2 demand indicators that I watch are mortgage applications from the Mortgage Bankers Association. These are purchase loans. So these are not refi loans. Refi loan activity is off about 80% from peak. So let's not even talk about that. But purchase loan applications are off about 30% from a year ago, which means fewer people are applying for loans because fewer people can afford homes at today's prices. Not surprisingly, the other index that's down about by the same amount is pending sales. So this is something that's published by the National Association of Realtors, and it shows contracts that have been signed, but the transaction hasn't closed or been recorded yet. It's a very good predictor of future home sales. So these are showing that demand is much weaker than it was prior to mortgage rates going up, which, you know, from an affordability standpoint, isn't a huge surprise. And what this has meant is that home sales are down. In fact, June was the 22nd consecutive month where existing home sales were lower than they were the year before. Last year's chart, the blue lines you're looking at is I've never seen that chart. Well, I've seen the chart before because I use it all the time, but I've never seen a year perform like that, where the highest month of home sales in the year was January. And every month after that, we saw fewer sales than the month before. I don't recall that ever happening, ever. And we basically lost the entire spring and summer selling season. For people that wonder if this was part of the Federal Reserve's design, don't think twice about it. It absolutely was. one of the inflationary factors they desperately wanted to get under control, they didn't say this too much out loud, but was the price of homes. And going up to 15-20% a year, it was just untenable. And they didn't want to see another bubble and bubble burst. So this was their way of kind of controlling for that. So, but it has had an impact. Beginning of the year, I was forecasting that we'd see 4.3 to 4.4 million existing home sales. That's down from about 5.2 last year and about 6.2 the year before. So pretty significant drop. Right now, it looks like we're going to be closer to 4.2 at the end of the year than 4.3 or 4.4. I do believe the second half of this year will feel better and look a little better than the first half. So I don't think we'll go down from there. In fact, I might be a little bit pessimistic there. One of the reasons besides affordability is inventory or lack thereof. The dark red line you're looking at here, this is data from Altos Research. They publish this stuff weekly. We're showing about 460,000 homes available for sale. And again, that's weekly. The NAR data you see is for the month. So this is a little different. And that's down by about half from where we were going back to 2019, which was probably the last normal year that we have. So we're just not seeing the inventory come back. I don't expect to see inventory come back anytime soon. If you're a homeowner sitting in a $500,000 house with a 2.5% mortgage, to go buy a $600,000 house with a 7% mortgage, you just can't make the math work. So these folks are sitting on their assets, and they will continue to do that until market conditions improve. That's keeping inventory levels down. So really, the only properties coming to market are by people who either have to sell or feel like they need to sell, or they just had another kid, they need a bigger house, they got transferred, or they're in some sort of financial distress. And we're going to continue to see inventory levels relatively low. To put this in perspective, by the way, nationally, we have about a 3-month inventory of homes available for sale. In a balanced market, a healthy market, we would have twice that, 6%. One of the reasons I do not believe we'll have a housing crash is because of that lack of inventory. Even though demand is down, inventory is down further. If you go back to the inventory levels right before the housing market crashed in 2008, 2009, we had a 13-month supply of homes available for sale. So we had more than twice what the market can normally absorb. When things started to go sideways, the whole house of cards crumbled. And that was partly because we had that overhang of inventory. Prices have been protected because of that lack of inventory. And we saw NAR report its 4th consecutive month of home prices being lower than they were the prior month. That's after an unprecedented run of year-over-year price increases for several years. Theirs is the blue line there, and you can see that they actually went negative year-over-year. The Case-Shiller numbers, which are very frequently reported in the press, are just now starting to go negative year-over-year. But prior to this, what we were looking at was home price appreciation, but at much slower rates than what we'd seen in 2020, 2021, the early part of 2022, precipitated in part by those historically low mortgage rates. I will point out that the June numbers from NAR showed that June median home prices were the second highest on record. And they were 0.9% below last June, which is the highest month on record. So if I were to look at home prices nationally, I would submit to you that they may have bottomed out. And we've seen other indices like the FHFA, which controls Fannie Mae and Freddie Mac, show that year-over-year home prices are actually up 3.1%. If you look at the Pacific region, the Mountain region, those are the two regions where we have year-over-year declines. And one of the reasons I'm sharing this data with you is to reinforce the point that as investors, you almost have to ignore the national numbers. You really should be focused more in your region. So I was very strong coming out saying I didn't believe we'd have a housing crash because none of the dynamics are in place. But I did say we'd have a correction. I was probably too pessimistic. I believed property values nationally would fall year over year, maybe 3 to 4%. They're likely to be flat or even a little bit up by the end of the year because of the supply-demand imbalance. But what I was right about is it's been a very localized correction. So if you're in coastal California, the Pacific Northwest, Phoenix, Boise, some of the other high-flying markets, Austin, that did so well during the pandemic, you're looking at year-over-year price declines of double digits. On the other hand, if you're anywhere else in Texas, pretty much, if you're in Florida, if you're in the Carolinas or Tennessee, you're seeing price increases year over year. So you really need to become a local market expert, either where you live or where you're investing, to understand what the trends are in those markets. And I would encourage you not just to look at the prices, but look at some of the underlying economic data. Look at job growth, look at population growth. If you're in a market with positive job growth, positive economic and positive population growth, you're going to be in a market where the housing market is pretty healthy. And the inverse is true as well. So Pacific region, California lost 300,000 people last year. The governor is trying to wave it off and say, oh, they're all retirees, but no, we're losing retirees. We're losing people in the middle of their career, and increasingly we're losing young college graduates. I'm getting close to retirement age. My wife and I are talking about which state we're going to move to get out of California. My young adult son and his fiance, in their mid-20s, both college graduates, are talking about what state they'll need to move to if they're ever going to become homeowners. So it's a very real issue. You're seeing California, you're seeing Illinois, you're seeing New York State with triple-digit declines in population, while you're seeing the southern states and some of the mountain and Midwestern states other than Illinois showing population gains. So understand what's going on in your local market is the moral of that story. New home sales are doing a little bit better. I was forecasting about 600,000 new home sales this year. It's likely going to come in somewhere between 650 and 700,000. And there's a reason for that. And the reason is they're available for sale. So people that would love to be looking to buy existing homes can't find anything and are tapping into the new home market. One of the reasons they're able to do that is because new home prices are down about 15% year over year from peak. And so again, compare that to what we just saw in existing homes, where prices are either down by 0.9% or up by 3%, depending on whose index you look at, whereas new home builders are offering concessions, whether it's in price, whether it's contributing cash to buy points to get mortgage rates down, or just upgrades to properties. So they're dealing, and they have properties to sell. They don't have a ton of properties to sell because despite what you read in the paper, housing starts are not up, they are down. We're seeing a record number of multifamily units, apartment units coming to market this year. Could be over 1 million apartments coming to market this year, but single family housing starts are down year over year, and they were down this past week. It was announced month over month as well. So the builders are not going to overbuild. They're not going to risk building in a market where demand is relatively weak and interest rates are relatively high. And this is another way of looking at it. I apologize for chart overload, but I like this stuff, so I hope you do too. This shows new home construction in 3 stages. The gray area is where there's been a permit issued or a lot's been cleared, but construction hasn't started. The red line is properties that have been completed and are available for sale. And the blue line is properties that are under construction. And we're coming off a really, really weird period about a year ago, where we had the highest number of homes under construction in history, and we had the lowest number of completed homes in history. And part of that was supply chain disruptions. Part of it was labor shortages, but builders just couldn't get what they needed to get these homes completed. Now we're seeing those numbers normalize a little bit. The builders are working through that glut of homes under construction. So the blue line is coming down. The red line isn't coming up as much as you would expect because as soon as those properties are completed, they're selling. So they don't actually add into the inventory of homes completed and available for sale. But you see that gray line was kind of inching up. So those permits, those lots being cleared, that was climbing, but now it's declining again as builders are exercising caution. They kind of panic when they hear the word recession, because the last thing they want to do is get stuck with a bunch of available inventory when a recession hits. So that's what we're seeing right now. We would probably sell more homes this year if the inventory would go up. But again, I don't expect to see that happening. Investors, interestingly, have continued to be very, very much a part of the residential housing market. This data just came out this past week from Adam Data, my former employer. And the gray lines at the bottom are the percent of purchases of residential properties by quarter, and that's by investors who buy 10 or more properties a year. And that's what they categorize as institutional investors, although we all know flippers who buy 10 properties a year individually, but that's a whole different discussion. The green area is the percentage of cash sales. And we all know that the overwhelming majority of cash sales are also by investors. And if you look at that last quarter, about 42% of all home purchases in the quarter were by investors and cash purchasers. So huge impact on the housing market. That's down from about 45% the quarter before, but still, relatively speaking, it's a very high percentage. And I suspect for the next quarter or two that are reported, we're going to continue to see that as a high percentage, because your traditional consumer home buyer, frankly, is just challenged by affordability issues. So it opens the door for more investor purchases. That said, we're seeing a trend, and I shared a report I just did with Charles, who I think will make it available to everybody a little bit later. But we're seeing a trend that investors are moving increasingly toward rental options rather than fix and flip. And again, this is another report from Adam where they track fix and flip volume. And in the last quarter they reported, which is Q1 this year, it was the fourth consecutive quarter where there were fewer flips than the quarter before. And we were actually down to 70,000 flips in that quarter, which is the lowest number we've seen in about 2 years. So it's been a much more challenging market for fix and flip investors over the last few quarters, as prices have stopped going up, and in fact went down in some markets. Demand weakened a little bit, and the people who would have normally bought those flip properties were having affordability challenges. So we've seen it be a little bit of a tougher time for fix and flip investors. One ray of light on this chart is that blue line that you see. Actually, I take it back. That's the blue line does show that the percentage of flips is higher. I was talking about another chart I didn't include here, but I'll give you the ray of light. So even though the number of flips was down, the percentage of sales they represented went up. So that means that investor sales were accounting for a higher percentage of residential property sales in the quarter. The other glimmer of hope is that they also reported that in the first quarter, for the first time in a number of quarters, gross profit margins were going up. So this is coming off several consecutive quarters where gross margins were going down. Now, I say gross margins, take that to heart. It's not net profit, it's gross margins. How much did you pay for the house versus how much did you sell the house for? It doesn't include your finance costs, your labor costs, your material and repair costs, your insurance, your taxes. None of that stuff's included. But the gross margins have been going down steadily for many months. And this is the first time they trended up. So again, both from a percentage of sales and a gross profit margin perspective, we are seeing that investors have some opportunities going forward. And I do believe that because of this limited inventory, for investors that are able to get properly priced properties that they can add value to with their flips, you will see more flipping activity. To give you some percentages, I was talking to my friends from auction.com today. The people that buy on their platform, last year, about 60% of those people flipped the properties. About 30% of those people held on to them as rentals. This year, about 50% are flipping and about 39% are holding on to them as rentals. So about a 10-point swing in both directions. And the report I just analyzed, which interviewed about 300 investors across the country, showed that about 2/3 of them are holding on to properties for rentals right now. So and there's another group that's wholesaling. So there's opportunities across the board, but in today's market climate, it seems like a lot of investors are voting to hold rentals rather than to try and flip. I know a lot of you are interested in distressed properties because that's a great way to find that property at a below market price and add some value to it and resell it. The bad news for you is that, again, despite what you might be hearing from people selling you bad stuff on YouTube, there is not a wave of foreclosures coming. In fact, delinquency rates are now below normal levels. If you look at, the mortgage bankers have been tracking this since the 1970s. On average, your delinquency rate is somewhere between 4% and 5%. Right now, it's below 4%. And there's a very, very strong correlation between unemployment rates and delinquency rates. When this report was done, the unemployment rate was 3.5%. Delinquency rate is 3.56%. Can't get a lot closer than that. So if we do have a recession, if we do have unemployment rates go up, you'll see more delinquency rates go up accordingly. But we're looking at very, very low levels of delinquency rates. If you see off to the left of that, where there's an 8.22 number in the middle of the chart, that was when the government's forbearance program was put into place. And we saw a serious spike in loans that looked to be seriously delinquent. They weren't seriously delinquent. They hadn't made a payment in more than 3 months, which is the technical classification for a seriously delinquent loan. But they were okay because they were in the government's forbearance program. And that meant they didn't have to make mortgage payments. So even though they weren't reported to the credit agencies as delinquent, they were counted by the industry as delinquent loans because there wasn't a payment made. And I spent a lot of time over the last couple of years walking people in from the ledge saying, calm down, because these people are only delinquent because they're allowed to be. And remarkably, of the 8.5 million borrowers, 8.5 million borrowers who went through the forbearance program, less than 0.5% have defaulted on their loans. In fact, about 40% either never missed a payment, they were just in there as a hedge, or they made all of their past due payments and then continue to make monthly payments, or they paid off the loan. And of the people who left with a modification program or deferral program in place with their servicer, about 80% have remained current since they left the program. So just a remarkably successful program. There was an East Coast economist who I follow because he's almost always wrong, and I find that highly entertaining and amusing. And he had predicted that about 35% of borrowers would be in forbearance, and that most of them would wind up being foreclosed on because they wouldn't be able to resume payments. And thank God he was wrong, because none of us would be sitting here today if that was the case. Because delinquency rates are down, because the forbearance program has probably prevented 3 to 4 million unnecessary foreclosures, foreclosure activity is very low as well. In a normal market, about 1 to 1.5% of loans are in foreclosure. In today's market, it's just over 0.5% of loans. And we're only running at about 60% of the level we had in 2019. And I should point out that 2019 was a year where we had below average numbers of foreclosures. I want to share with you a little bit more granular breakdown on this. The foreclosure activity varies very, very dramatically depending on where you are in the country. If you're in New York State, you're back to normal levels. You're at about 1.5%. If you're in California, you're at about 0.2%, way below average. And one of the reasons for this is the blue states, which, as you can see, by and large have higher percentages of loans in foreclosure, do judicial foreclosures. So New York State, the time between the initial notice of default and the sheriff's sale on average is 2,400 days. So once you get a foreclosure notice in New York, you're going to be in foreclosure for a long time. So it's not really necessarily that the market is that much weaker in New York. It's just once you're in foreclosure for a long time. Same thing in Hawaii, which is almost 2,000 days right now. So a lot of these judicial states just have long foreclosure timelines. And it's not necessarily that there's that big a problem with the number of loans in foreclosure. But if you're in Georgia or Texas, you get a foreclosure notice, you're done in 90 days. And so that loan is no longer in foreclosure because it's no longer a loan. So just wanted to show you that and show you that foreclosure starts, those first foreclosure notices somebody gets, are back up to about 80% of pre-pandemic levels. So we're seeing more properties enter foreclosure relative to the overall numbers. And if you just do the math and continue to follow how foreclosure starts have been increasing since the pandemic, we should be back to more or less 2019 levels of foreclosure starts into this year, sometime in the first quarter of next year. So we're getting closer and closer from the standpoint of foreclosure starts. The number of properties getting to auction, which is the next stage of foreclosure, is still running at about 50% of pre-pandemic levels. So something's happening between when the property gets that first foreclosure notice and when it should be going to auction that is skewing these numbers a little bit. So we're still at about 48% of pre-pandemic levels for the properties getting as far as the auction sale. And if you look at REOs, bank-owned properties, the properties that get repossessed if they're not sold at the auction, we're running at about 30% of pre-pandemic levels. So typically, you would be seeing many more REOs, you'd be seeing many more properties get auctioned, but we're not. And there's a couple of reasons for that. One is that borrowers in foreclosure have unprecedented amount of equity in their properties. So 92% of borrowers who are in foreclosure today have positive equity in their homes. So when I did this analysis, there were 270,000 borrowers in foreclosure. And the pushback I usually get is, oh, they may have equity, but they don't have much. Well, au contraire, as my French friends would say. Of those 270,000 people who were in foreclosure, almost 100,000 of them had between 20 and 50% equity in their properties. Over 60,000 of them had between 50 and 75% equity, and about 35,000 of them had more than 75% equity. Now, I don't want to sound cavalier or heartless or uncaring, but if you have 50 to 75 or more than 75% equity in your house and you lose it to a foreclosure sale, shame on you. And increasingly what we're seeing is people are not taking that chance. So just to kind of do those numbers real quickly, that means that 195,000 of the 270,000 people in foreclosure have more than 20% equity, which most people will tell you is plenty of money to pay off your past due debts, pay your realtor and your other closing costs, and still walk away with some money in your pocket. And so what we're seeing, and I just got this number from some friends yesterday, is of the properties that are sold as distressed properties, they're in some stage of foreclosure, 64% of those properties are selling in the pre-foreclosure stage. So they got that initial notice of foreclosure and they're selling their property to protect their equity. If I'm an investor in today's market looking for distressed assets, that's where I'm looking. You find those homeowners who are in financial distress, and you're going to ask, why are they in foreclosure if they have 75% equity? Equity doesn't protect you from going into foreclosure. You lose a job, you get a divorce, you have an unexpected medical bill that hammers your savings, whatever, some sort of financial catastrophe that happens to the household, that's what puts you in foreclosure. And once you're in foreclosure, you have a hard time tapping into that equity because now your credit rating's been ruined and the lender won't touch you to modify your loan. Even if you lost a job and now found a new job and you could make your regular payments, really tough for those buyers. So whether you're a fix and flip investor looking to create a win-win scenario with that homeowner, get a property for yourself that's a little bit below market value, and by the way, probably in pretty good condition, because these aren't people that have been, financially destitute for years, and then flip the property at a profit, or you're a rent property owner, you might have a tenant in place who's a good credit risk. So you can buy the property, leave them in the house as tenants, and secure that. So this is where I would be looking. The next place I would look is at the foreclosure auctions themselves. So there are fewer of these properties getting to auction, and the sell-through rate at the auctions is unusually high. Before the pandemic, you'd see a sell-through rate of 30 to 35% at the auctions. Today, it's between 60 and 65% most of the time. So that just leaves fewer and fewer properties for the lenders to repossess. Fewer properties getting to auction, more properties selling at the auction on a percentage basis. So the strategy this time is not wait for the banks to repossess the properties. It really isn't. Because in my mind, it's going to take a while for those numbers to come back, and they may never come back at the same percentages we saw previously. And in fact, just to kind of put a pin in this, right now, the average number of days it takes to complete a foreclosure across the country is about 1,200 days. And that's a blended number, and states like New York and Hawaii skew it a little bit, but this is partly due to the forbearance program. People have been in forbearance for 2.5 years. That just makes the foreclosure timeline stretch out a little bit further, because a lot of those people were in trouble before the pandemic and got a reprieve because of the forbearance program and the government's moratorium. So why aren't we seeing more REOs? Well, those foreclosure starts you're seeing today aren't going to be going to auction, aren't going to become REOs for another 1,200 days. So, something that's going into foreclosure today may not come to market for a year or more, based on what we're seeing. So move upstream. If you're interested in distressed properties, take a look at what's available in the earliest stages of the foreclosures, if at all possible. And I'm sure through organizations like National REIA, there are training programs available on how to buy foreclosures. Don't go to an auction unless you have an idea what you're getting yourself into. Go to an auction, watch a couple of them so you get a sense of what's going on. But it's a terrible place for people to go that are inexperienced and really haven't done their homework and educated themselves, because you can lose a lot. Yeah, I know somebody who called me to tell me very proudly he bought a house for $20,000 at an auction. Turned out what he bought was a second mortgage on a property that was underwater. So he basically just blew $20,000. So be careful. Some quick closing thoughts. I do believe a recession is likely. Do believe it'll probably be a fairly short and a mild one, and unemployment rate shouldn't get out of control. I am very hopeful that unless inflation spikes again, we could see mortgage rates under 6 by the end of the year. And I believe they'll go down next year as well, which should make affordability. By the way, the affordability besides the mortgage rates, again, home prices have settled down very, very significantly. First time in years that wages are growing faster than home prices and wage growth. So more nominal home prices, flatlining kind of, mortgage rates coming down a little bit, wages going up. Gradually, affordability gets a little bit better. Existing home sales are going to decline from last year. New home sales may be a little bit better than expected. Prices are declining in the new home market, but we might have bottomed out in the existing home market, hopefully. Your colleagues seem to be shifting to a buy and hold strategy from fix and flip, although I do believe we might have hit the bottom on fix and flip too. That might be coming back. And really no wave of foreclosures anywhere on the horizon. Extraordinarily good loan quality, very low unemployment rates, tons and tons of equity. So the likelihood of a big wave of foreclosures, if somebody's trying to sell you a program for that on YouTube, don't buy it. They're selling you snake oil. Come follow me on LinkedIn instead. I'll talk you back off the ledge, and I won't charge you anything for that. So Charles, thank you so much for the time today. I'm afraid I probably ran a little bit over. But we covered an awful lot of ground. And for anybody that wants to follow me on Twitter, there's my Twitter handle. Happy to have you on board.
No, Rick, that was fantastic. I'm still taking in the data and processing, as it were. So thank you. Thank you for falling in here, and just appreciate that. I want to come back to a point you said early on, and you mentioned about the 5% unemployment rate could climb up to. But even when we had the peak unemployment during the pandemic, a lot of those were non-homeowners.
Right.
And with them being non-homeowners, that minimal impact then that transfers through the economy. And yeah, there was money flowing through, but it was, I'll call it survival money.
Yeah.
You're kind of just churning, surviving, but it didn't have that impact on the housing market, which is good. Yes, there are people who want to take advantage of the foreclosure, but that's not good for overall stability for the country and the economy. So looking at that, and I wonder to some degree if there's a parallel with the foreclosures and with the evictions kind of stabilizing back to those pre-pandemic levels at this point. And to me, that's a good sign that we're reaching stability. Does that make sense?
Yeah, I think you're absolutely right, Charles. And I'm sure you guys have all read the headlines about the millions and millions of people being evicted today, right?
And still looking for the numbers.
So I was on top of the mountain screaming my lungs out when I was reading in the media that there are 20 to 30 million people in danger of eviction. And I based on what?
Yeah.
And if that happened, we wouldn't have a housing problem. We would have a blood in the streets problem. So clearly that didn't happen. And one of the other things that happened with housing, Charles, and this not only did housing not take a hit during the COVID recession, but it accelerated out of it. And by the way, historically speaking, the housing market has led the economy out of recessions very, very regularly, particularly new home sales. But in this case, to combat what they feared was going to be a big economic downturn, you might remember that the Fed slashed the Fed funds rate. It was down to 0. And that drove mortgage rates. And plus the Fed bought trillions of dollars in mortgage-backed securities, which put a ton of capital into the mortgage market. So now you have people going out and saying, hey, I can buy a house with a 2.5% mortgage that'll be locked in for the next 30 years. So they all rushed to go to market to take advantage of that, which boosted prices even further. So we kind of had this bifurcated recovery where people that could afford to get into the market did very, very well for themselves. And the good news is the government also didn't neglect the renters. There were a couple $1 billion set aside for rental assistance programs for people that did lose their job to tap into to be able to pay their back rents. And I believe that also helped a lot of landlords avoid having to sell off their properties or go into foreclosure. So we are seeing a return. We're seeing a little bit more in the eviction world. We're seeing a little bit more in the foreclosure world, but we're still below normal levels. And once we get back to normal levels, I don't think people should be freaking out, because that's just historically where we are. If you give me another industry where your success rate is 99%. It's a remarkable thing.
Well, and I think if you throw that in there and then you throw a background in and say, okay, so the US, and we have very commonly a 30-year mortgage.
Yep.
Whereas our partners to the north in Canada, they're looking at 3- and 5-year adjustable rate mortgages.
Yep.
Britain is in the headlines because everything's adjustable rate and short term, and they have to keep refinancing. And as the economic, I think we're kind of back to that post World War II time frame where if US gets a cold, Europe gets a flu, and we're kind of having that. And part of that stability for us is that 30-year mortgage. So the folks who go, to your point, no, I'm not going to buy a $700,000 home at 7% or what. I'll sit tight for a few years. And, that helps our partner Home Depot as people go through and reinvest in their property. But at the same time, we can outlast it. Instead of having that increase in economic volatility, we can really stabilize. And I think we're going to continue seeing that, especially with a good housing and a good job market. And a stable job market, still being a brain drain for the rest of the world, that's a good thing for us in a very kind of optimistic sense.
Yeah, you make a really good point, Charles. There would be carnage in the housing market if those folks, and let's put some numbers to this. 93% of homeowners with a mortgage have a mortgage below 6%.
Yeah.
70% have a mortgage below 4%. Imagine if 70% of people with a mortgage, so 38 million borrowers. Imagine if 3 years from now they had to adjust their mortgage from 3.5% to 7%. The number of defaults and foreclosures would make your eyes spin.
Yeah.
So yeah, the 30-year does protect us. We've actually seen Ginnie Mae authorize for loan servicers, mortgage servicers, to extend terms out to 40 years for borrowers who need to have their loans modified, because the servicers can't modify them into a lower interest rate loan anymore. So the other option is to extend the terms a little bit. FHA has put a program in place that will basically take a part of your mortgage and reattach it to your loan as a silent second loan that isn't due until the end of the mortgage term. So if you have a $200,000 mortgage, they take $50,000 of it, put it at the end of your loan, and re-amortize your loan at $150,000, so you can make payments. So there's a lot of activity going on to help prevent more defaults and more foreclosures. And to your point about the job market, we actually need more immigration. And I know that's a political third rail, but the immigration I'm talking about are people that can come in on H-1B visas and fill higher paying jobs that are crying for workers right now, but can't find them. And those folks do tend to come in and rapidly become homeowners. But we also need more workers because, frankly, boomers are all moving into Social Security age, and there may not be enough workers to continue to feed that pyramid at the bottom. So it's an interesting time for the U.S. economy and the U.S. housing market, but we are absolutely in much better shape than most of the rest of the world.
Absolutely. Well, Rick, the thank yous are pouring in, and we just want to say thank you. It's getting late on a Friday, and appreciate your time and appreciate your vast amount of information and data there. Thank you for that. With that, any following comment? Otherwise, I'll turn it back over to Rebecca, right?
I would just say if anybody has any comment or questions we didn't get to, my email address is in the presentation. Feel free to pop me a note. Always a pleasure to talk to real estate investors across the country. Really appreciate the opportunity, Charles, and hope we can do this again in a few months.
Sounds good. We appreciate it. And we will be sharing out, when we share out the link, we'll share out your PowerPoint as well separately, so people can really dig into that.
Thanks very much.
Thank you. Rebecca?
I was just going to say, everyone check your email. You'll be getting a follow-up from this. And we just want to say again, thanks so much, Rick. We really, really appreciate your being here. I know he's at a conference and had to run. So the fact that he carved out time for us was awesome. Thank you for being here. We really appreciate it. We'll see you back here next month. Same time, same place, same bat channel, for those of you from my generation. And we'll have Victoria Cowart here, who has been very welcomed and very popular in the past. So thank you so much for being here. If you have any questions, make sure that you reach out to Charles or myself, and we will see you then. Have a great day.